Hey guys, we are super excited to have you join us for today's trading masterclass. In today's training, we are going to teach you how to trade like a pro in 1 hour, which has never been done before. Over 1 million people have gone through our free content online, and we have trained thousands of traders. And for the first time ever, we are doing this exclusive trading masterclass, and you are the first to experience it. We're only doing this for a very limited time. So in this training, we are going to cover 3 core concepts. 1, we will reveal to you our biggest trading secret and technique we use every day that we have never shown anyone before. 2, we will show you the #1 reason 90% of traders fail, and it is not what you think, and our strategy to get around this problem. And 3, why trading is not guessing and how we use dynamic price action for spotting trade entries. Again, trading is not guessing, and this is a core theme to this training. As an added bonus, at the end of this training, we will give you our key trading blueprint and trade entry checklist, which are both very important to have, as you can use them as a step-by-step guide to identifying trade entries. So first, let's dispel some of the trading myths. Trading is hard and takes a long time to get good. The concept of hard only exists because people have access to the wrong information, meaning going online and spending months or years trying to apply concepts that don't work. We have filtered all the useless information for you and are only teaching you the concepts that work. Over the next hour, you will see how fast you can learn with the right information. You need to start with a lot of money. Forex brokers provide leverage, meaning you can start as small as $100 and be able to trade effectively. You can lose a lot of money fast. Your risk per trade is always capped, meaning we always have a set amount of risk per trade through the application of a dynamic stop loss. We do not go for the home run every trade. Trading is about taking calculated risks and consistently pulling money from the market over and over again, not risking your whole account every trade. Trading takes a lot of time every day. As a swing trader, you only need to check the chart a few hours or less a day. You can even do analysis from your phone if you choose. We apply both swing trading and day trading strategies. So whether you want to spend little time in front of the screen as a swing trader, or a lot of time in front of the screen as a day trader, we have strategies for both types of traders. Trading involves luck or guessing. Price action and understanding candlesticks tells us exactly what we need to know. We let the market show its hand and reveal to us what it wants to do next. No guessing involved. Trading is more of a reaction to what we see materializing in the market. Now, there are 2 types of traders that exist. There is this guy, the angry, frustrated trader, the guy who spends months and years watching every video online and trying every indicator, only to be left losing money and worse, losing time they'll never get back. And then there's this guy, the happy and motivated trader, the guy who understands that true trading experience and knowledge comes from accessing mentors. Use us as a shortcut to trading success. We know how important your time is, hence why we are always about providing information that matters. If it doesn't help you as a trader, we don't talk about it. So let's get right into it. Again, notice that we are using a clean chart. No indicators, no flashing colors, just a clear layout. In order to trade like a pro, you need to be able to read pure price action. Everything you need to know is right in the candlesticks and in price action. And after this training, you will understand exactly why trading is not guessing. So in this training, we are going to go through step by step on how to break down pairs for trade entries. As a reminder, we are including an in-depth document of this exact strategy, as well as an entry checklist at the end of this training for free. So make sure to stay until the end for that. as it is a detailed blueprint with info that is not discussed inside this training. So here are the exact steps we use to qualify a trade entry. Step 1, identify a level of dynamic support or resistance. Step 2, look for price action patterns. Meaning, once price gets to these levels of dynamic support or resistance, we need to look for key price action patterns before even considering a trade entry. Step 3, time frame confluence. So if the previous 2 steps are satisfied, meaning we have good price action at a dynamic support or resistance level, then we look for time frame confluence. Meaning we want all time frames to be telling us the same thing. And step 4, intraday confirmation and entry. Now, we only make it to this step if all of step 1, 2, and 3 are satisfied. What we use intraday confirmation for is to further confirm our immediate trend and to look for a precision. Now, let's go through each of these steps right on the charts, starting with step number 1, which is identifying dynamic support and resistance levels. So as a refresher, 2 very key traits we like to look for when identifying dynamic support and resistance levels is an area where price has reversed from drastically, and it should be obvious, meaning the level should jump right out at you. And the reason for this is simple. The more traders who can see the level means the higher the possibility that more traders will be taking action, meaning buying and selling at the level, which causes price action patterns to form. This is very important. Buyers and sellers taking action at key levels is what causes price action patterns to form. Without buyers and sellers taking action, price will just blow through these levels and the level becomes invalid. So here is the Euro Swiss weekly time frame. And we always start on the weekly, meaning each candle represents 1 week's time. Remember that we want to focus on the obvious levels. So you should be able to spot these levels within seconds of looking at the chart. Now, starting at the very top, price came up, hit, and reversed drastically. So we draw in a level of resistance. Next, look to the left of the level we just drew in. Try to spot the obvious level yourself. Can you see it? Right here. See how obvious the level is? Price came up, hit, and reversed. So we draw in this level of resistance. Now again, look to the right and try to spot the level of resistance. I know you can see it. Right here. Price came up, hit, and reversed. We draw in another level. So let's keep going. Below and to the left of the level we just drew in, there is a level of key support. Again, try to spot the level yourself. There are multiple rejections of this level where price came down, hit, and reversed from. So we draw in another level. And notice how when price broke through, it came back to reject this level as resistance recently, which was a good short trade opportunity. Now, one final level, the extreme swing low. Again, spot it yourself right away. Right here. So there you have it. All the key levels drawn in. So whenever price approaches these levels, we look for price action patterns before considering possible trade entries. Now let's do this again on another pair. Now in this example, we are going to go through each step. Here is the dollar yen, and again, we start on the weekly time frame. We had an obvious swing low down here, So we draw in a level. We had 2 rejections here, so we draw in another level. Now, as a reminder, there are other minor support and resistance levels in between. But in this training, we are only focusing on the key dynamic levels. So we will go through a trade we recently took on this pair. If you look along the top, we spotted the 3 points where price hit and reversed from drastically. So we drew in this level of dynamic resistance. Now, this is when we make it to step 2, which is to look for price action once price gets back to these key levels. As you can see, price recently came up to this level again and rejects the level with a perfect long wick candle, which is one of our favorite price action patterns, as seeing wicks sticking out at key levels like this is a sign that price is indeed reacting to the level. Now, most traders when learning to trade spot this key level, see this amazing long wick candle rejection at this key level, and they jump right into a trade short. And here's where the problem lies. Jumping into a trade short like this would be guessing, because you are assuming the price will reverse from this level just because of a candlestick. Don't forget that you're going counter trend, meaning you're going against the strong uptrend. So just jumping in short because you have a good candlestick at key resistance would be guessing, and trading is not guessing. Now, this is why we always want information, which brings us to step 3, which is time frame confluence, which means having the same directional bias on all time frames, whether it be bullish or bearish. So before we get to step 3, let's quickly go through these steps one more time to make this crystal clear. In step 1, we identified this key level of resistance here by spotting these 3 key rejections. In step 2, as price came back up to this level of key resistance, we wanted to see some kind of price action pattern form. Price action comes in many forms, which we will dive deeper into. But in this case, the price action pattern we got was this long wick candle that rejects this level of resistance. Now, this is a very key point. This long wick candle rejection of key resistance gives us a bearish bias, but an unconfirmed bearish bias. And the only way to confirm our bearish bias is through step 3, which is time frame confluence, which means jumping to the daily time frame to also look for bearish price action to match the weekly bearish price action. So let's jump to the daily. Now, here on the daily time frame, we are again looking for some form of bearish price action to confirm the weekly bearish unconfirmed long wick candlestick rejection. So we had this false breakout, and then we get bearish price action through the break of this trend line with this bearish momentum candle, including a lower low. Now, this is why time frame confluence is important, because without the break of trend line and without price making this lower low, then there would be no bearish price action on the daily, and price could easily continue this uptrend on and on and on. So again, to make this clear, after seeing the long wick candle rejection of resistance on the weekly, we looked for bearish price action on the daily to confirm the weekly, which we got through this break of trend line and price making a lower low. Again, no guessing. We wait for price action to show us where price wants to go next. Very key point. Not knowing how to use different time frames is one of the key reasons why most traders fail, as they don't know true market direction. as there are trends with trends. So here's the kicker. Even at this point, there is still no trade. And here is one of our secrets for you. And is also step 4 of this formula, which is using the intraday time frame, specifically the 4-hour time frame, for confirmation and an entry. The reason we use the 4-hour time frame is because we want to dive even deeper in order to look for even more bearish price action to further confirm the reversal, as the daily time frame is still the bigger picture and doesn't tell us enough. So let's jump to the 4-hour time frame. So I'm sure you have seen many charts in your life and know what uptrends and downtrends look like. In an uptrend, price looks like this, where you have a run and a pullback. A run and a pullback. A run and on and on and on. Notice how the swing low is always higher than the previous low, meaning in an uptrend, price makes higher lows. The same along the top. The highs of the runs are higher than the previous high, meaning in an uptrend, price makes higher highs. So how can you tell when there is a trend change? Well, price will either make a lower high or a lower low, which shows the loss of momentum at the start of a trend change. This concept is a simple yet powerful price action concept that we use every day in our trading. Yet most traders fail to use this concept correctly. So back to step 4. Here is the same uptrend we were looking at on the daily. Notice how here on the 4-hour time frame, we can see a lot more detail and data in regards to this uptrend. So we are looking for bearish price action here on the 4-hour time frame to confirm the daily and weekly bearish price action. As you can see in an uptrend, price is making higher highs and higher lows. Our first signal of a possible trend change is this lower high, followed by a same low and another lower high. And for the more advanced traders, this also makes a head and shoulders pattern as their neckline is. Now, even at this point, there's still no trade. The key price action that confirms all the time trades is this bearish momentum candle that breaks the head and shoulders neckline, breaks this long-term trend line, and creates a clear lower low. And this is where we enter. Now let's go through this one more time. In an uptrend, we have a run, a pullback, a run, pullback, a run, pullback, a run, pullback, a run, pullback, a run,
Mẹ chịu phò ra rồi mẹ.
a run, a pullback, and then boom. A lower high, another lower high, and then finally the clear lower low that breaks the trend line with a bearish momentum candle. So to recap all this again from the top down, because we really want you to completely understand this concept thoroughly. Step 1, on the weekly time frame, we identified a key dynamic level of resistance. Step 2, price came back up to this level. We got a long wick candle rejecting key resistance, which is a good price action pattern. This gives us a bearish bias, but unconfirmed. So we needed to confirm it through time frame confluence, so we jump to the daily. Step 3, we start looking for bearish price action on the daily to confirm the weekly bearish bias. And we get this bearish price action through the false breakout at key resistance, showing that price failed to break out, followed by a break of trend line, which is another bearish price action pattern. We now have step 1, 2, and 3 satisfied. And only now do we go to step 4, which is going to the 4-hour time frame for confirmation and bearish price action to confirm the daily and weekly and to look for an entry. We are now on the 4-hour time frame, and remember we have weekly bearish price action, daily bearish price action, and we need to look for further bearish price action on the 4-hour as confirmation. And we finally get that through the bearish momentum candle that breaks this trend line, breaks the head and shoulders neckline, and makes a lower low. And as a bonus, and something we love to see, is the bearish momentum candle, as it shows selling pressure. Now, there are many ways we enter and exit trades, as well as manage trades. But in this scenario, we enter through a breakout strategy, meaning entering at the low of this candle, stop loss above the neckline and above the trend line, and a profit target at 1-to-1 away. The reason we have our stop loss above the neckline and the trend line is because we don't know if price will move straight down, as it can often swing around before it goes in the direction you want. So if you put your stop loss too tight, meaning you're choking the trade, it can be hit before it goes in the trade direction. There are many ways to manage an open trade, which we dive deeper into in our program. So let's jump to another pair we're currently looking at to show you this again. Here's the dollar Swiss, and we want to burn these concepts into your mind. So starting with step 1 again, we want to identify a dynamic level. Look along the top. You should be able to spot this level in an instant. Try to spot the level yourself. Can you see it? So here it is. Price came up, hit and reversed drastically. Again, price came up, hit and reversed. And again, price came up, hit and reversed drastically. We have a total of 3 rejections of this level. So we draw it in. So again, if you were wondering, why did we have to draw in this level? If price came up, hit this level in the past and reversed, then as you can see right now, right at this moment in time, as price has come back up to this level, there is a possible short trade opportunity. Now, just because price came back up to this dynamic level again, we do not jump into a trade short blindly and try to guess that price will reverse, because this is still a very strong uptrend. We need step 2, which is we need price action patterns at this level for considering any kind of entry. So to answer another question you probably have, why do we need price action? Now, this is very important to remember. Candlesticks tell a story, meaning if buyers and sellers take action at these levels of support or resistance, that is what causes specific candlestick patterns to form, such as long wick candles like this. If traders are not taking action, price will just blow right through without price action patterns forming. Now, there are a variety of key price action patterns we look for, but for this specific training, we want to keep it simple. So here on the weekly, we had this candle with the long wick sticking out, but this is a bullish candle as it has a large body. And then the following candle has started breaking above this level of resistance, which is again bullish price action. So we have nothing yet that presents a short opportunity. So we don't make it to step 3, which is time frame confluence. Now, let's jump to the daily anyways to see if there is some kind of bearish price action, just so you guys can further understand this concept. Again, here in the daily, all we have is bullish price action, as price is making clear higher highs and higher lows with no bearish price action. If we were to look for a short trade, you would want to see bearish price action, such as a lower low form like this, or a lower high to form like this. At the moment, all we have is weekly bullish price action and then daily bullish price action. So no short trade opportunity at all. Again, no guessing. We wait for the market to show us where it wants to go next before acting on any kind of trade opportunity. We react to what we see materializing in the market. So let's jump to another example. Here is the pound kiwi, and I'll show you again why using time frame confluence and the intraday time frames is so important. in terms of looking deeper into the actual trend. So you look left and you notice price came up, hit and reversed drastically. So you draw in a level of resistance. Price breaks above and starts pulling back. And the average trader spots these perfect long wick candles rejecting this new level of support and thinks this is a perfect trade entry long. You have momentum loss through shrinking candles as price approaches this new support level, followed by these great long wick candles rejecting support. So you enter long, and this is where the average trader makes the mistake. Again, this would be guessing, because you are guessing that price will turn around and go up. But you are also forgetting that this is a current moving downtrend. So how do we get around this problem? You already know the answer by now. We use the 4-hour time frame to look for a trend change at this level before looking for a long trade. So let's jump to the 4-hour time frame. So here on the 4-hour time frame, this area here is where the long wick daily candles were forming. And now you can see clearly that this is a moving downtrend. There was no bullish price action of a trend change to go long. Lower low, lower high, lower low, lower high, lower low, lower high. This is a clear moving downtrend. There's no price action that shows a trend change here on the 4-hour time frame. If we wanted to go long based off of those long wick daily candles, we would want to see a trend change and bullish price action here on the 4-hour time frame to confirm the daily bullish buys. We would need a higher high and then a higher low and then enter through a breakout, because then the 4-hour time frame will be bullish, which then confirms the daily price action. So let's again show this concept on another pair. Here's the pound CAD. We first have our swing high up here. Next, we look left and noticed that price came up, hit and reversed, creating a level. So we draw it in. Now, as price came down to this level, we had no idea whether there was a trade or not until we saw momentum loss through these shrinking candles, followed by these multiple perfect long wick candles rejecting this key support level. Again, to make this clear, we did not guess that there was going to be a trade as price approached this level of support. We had the level drawn in before price got here, and only once we saw these two price action patterns form, which was the momentum loss through shrinking candles and the multiple long wick candle rejections of support, did we begin looking for a trade entry. So now, with this momentum loss and multiple long wick candle rejections of key support, this gives us a bullish bias that is unconfirmed. And we need to confirm this bullish bias by going to step 3, which is time frame confluence. Remember that we must use time frame confluence because this is still a strong downtrend. And without looking for a bullish trend change on the daily, we would be guessing by going long and assuming that price will reverse. And again, we do not guess. So let's jump to the daily. Here in the daily, we again need to look for bullish price action to confirm the bullish bias on the weekly. So if you look, we had this falling wedge pattern, which is a reversal pattern, but again, there's still no trade until we have this breakout occur. Now you're wondering, why is a falling wedge a reversal pattern? And the answer is very simple. It goes back to the same concept we have been discussing. In a downtrend, we have a lower low, a lower low, same low, a lower low, another lower low, and along the top, we have a lower high, a lower high, a lower high, another lower high, before we have this clear break of the falling wedge and price makes a higher high, which shows a clear trend change. At this point, the daily has confirmed the weekly, and we have satisfied steps 1, 2, and 3. So we move on to the step 4, which is confirmation through the 4-hour time frame. So let's jump to that. Here in the 4-hour time frame, we again had the break of the wedge. Price pulled back, retested the broken wedge, and then created a higher high with momentum. And you enter on the momentum candle. And you put your stop loss below this intraday SR level. So let's jump to another example. Here's the pound yen. And you look left and noticed price came down, hit and reversed. And again, came down, hit and reversed again, giving us a key level. So we draw it in. Once price came down to this level, we had no idea whether there would be a trade entry or not. We then had momentum loss through shrinking candles, as we had a big candle, followed by a smaller candle with the wick sticking out. Again, this isn't enough for a long trade, so we need to find bullish price action on the daily that shows a trend change. So let's jump to the daily. Here in the daily, we had all red candles before finally we had this green candle show, which shows momentum loss. And then these multiple long wick candles rejecting this dynamic level of support. But again, still no trade. Price then starts moving outside of this trend line. Do not forget that this is still a very strong downtrend, and just jumping counter trend without confirmation is guessing. And again, we don't guess. So let's jump to the 4-hour time frame for trend change confirmation. And here on the 4-hour time frame, the picture is very clear. We again want to see bullish price action to confirm the daily and the weekly for a reversal trade law. The first price action pattern we had is this triangle pattern, which is a reversal pattern. Now, why is this pattern effective? Again, back to the same concept we have been showing you this entire training. Lower low, lower low, before we had this triple bottom showing that price could not make a lower low. Along the top, we had the high, lower high, lower high, lower high, lower high, and then finally a break of the triangle, and price finally makes a higher high with momentum confirming the reversal. Now, all time frames are confirmed and you enter on this candle with a stop loss below the lows. Now, let's get into a trade that we are currently in using the same concept. So, here is the Aussie CAD long trade we are currently in. Now, we don't always use the monthly time frame as it is the very big picture, but we do use it when there is picture perfect price action like this. And we go deeper into this concept in our trading. Now, look at this chart. We looked left and noticed this very obvious level of dynamic support. Price came down, hit and reversed drastically, giving us 0.1. Again, price came down, hit and reversed drastically, giving us 0.2. Then as price came back down to this level, we had textbook momentum loss and this picture perfect, very long wick candle rejecting dynamic support. I don't think this price action could have been any more perfect. This then gave us a bullish bias but unconfirmed. So we need to confirm this through time frame confluence. So let's jump to the weekly time frame to look for bullish price action. Here in the weekly, price was making clear lower highs. It then hit dynamic support, and then finally we had a break of the very long-term trend line, and price makes a clear higher high with this bullish momentum candle, giving us very clear bullish price action that confirms the monthly. So let's further confirm this bullish price action on the daily. Here in the daily, price is making clear lower highs and lower lows in this moving downtrend. Price then reaches dynamic support. And price finally breaks through this very long-term trend line and makes a clear higher high for the first time in many months. And also makes a great, very bullish momentum candle. And this is where we took our entry. Monthly, weekly, daily are all confirmed bullish, so we don't need the 4-hour time frame. This is already more than enough, especially in our breakout trade. We now have our stop loss move into profit, and this trade is risk-free. Again, no guessing. Let the market show you when it's ready to be traded. Don't try to guess the direction. So let's jump to another example. So here is the Kiwi Swiss long trade that we are currently in. Now, we want to point out that this is an advanced price action momentum entry, and we dive deeper into these kinds of trades in our program. But for now, we will keep it simple to help you understand our thought process. So we first identified this key dynamic level that acted as both support and resistance, which is a very strong quality when identifying a dynamic level. The key to this trade is the bullish breakout through this long-term trend line and through key resistance, which shows heavy buying presence and gave us a clear bullish bias. This pair became of interest only after price broke through the trend line, broke through key resistance, which then makes a higher high and shows the end of the downtrend and the start of a trend change to an uptrend. To show this more clearly, here is the clear downtrend. Before we had the trend change to an uptrend. Now, even at this point, there is still no trade. We needed to confirm it on the daily. So let's jump to that. Here in the daily, we again were looking for bullish price action to confirm the weekly bullish price action. You can clearly see the lower highs and lower lows in this downtrend before we finally had this higher low form, which was our first trend change signal. This was then followed by this clear break through the long-term trend line, break through dynamic resistance, and price makes a clear higher high, which confirms the clear trend change to a fresh uptrend and giving us a bullish bias. So at this point, both the weekly and daily are bullish and are confluent. And here is the picture perfect entry. Price pulls back to reject this key dynamic level of support that we identified on the weekly with these picture perfect long wick candles. Now, here's the key we have been showing you. Even at this point, with all this confluence and all this amazing price action, and with these perfect candles rejecting dynamic support, we still don't enter. So why do we not enter? Because this pullback here is technically a short-term downtrend, and just going long would be guessing that it will go up again. So how do we confirm that this very short-term downtrend is over? We need to look for a breakout and trend change on the 4-hour time frame to confirm all time frames. So let's jump to that. So here in the 4-hour time frame, this is the short-term downtrend and pullback we were looking at on the daily. And you can clearly see prices making lower highs and lower lows. And only once price breaks this trend line did we enter, as we now had confirmation that the pullback is over and all time frames are confluent as bullish. Again, no guessing. We're letting the market tell us what it wants to do and reacting to what we see. Now, as you can see, we have moved our stop loss into profit, meaning the position is risk-free. If we are asleep, away doing something else, it doesn't matter, because if the trade comes back down, the position will close automatically in profit. Remember this very, very key point. Risk only exists when you don't know what you're doing. Now, here is the kicker. What we just showed you in this training is just scratching the surface. Yet you now know more than what 90% of other traders know. So now, looking at this chart, I know what you are thinking. It takes time for price to get to these key levels. But what happens in between these key levels of support and resistance? Aren't we missing out on a lot of the action? And you are correct. There is a whole nother world that exists once we dive deeper into the lower time frames, such as the 1-hour time frame, which involves quick entries in and out and what we call day trading. Now, we're going to give you a glimpse into this world. There is a key tool we use in combination with price action that gives us a huge advantage over other traders. So let's jump into the intraday time frames. Take a look at these lines on the chart. Notice what happens when price is below this line. Price is in a clear downtrend. Notice what happens when price breaks above these lines. We have a trend change and price starts an uptrend. Here in the Kiwi cat, again, downtrend when below these lines, breaks through and starts an uptrend. Now, this is only the tip of the iceberg. We use these lines and this secret tool in combination with our price action strategies for precision entries. When we discovered this tool, but more importantly, figured out how to use it correctly in combination with price action, it took our trading to the next level. You will never find this strategy anywhere else online. We are not overstating when we say you now know more than what 90% of traders know. Many of these other traders right at this moment are staring at a chart, applying a bunch of indicators and draining their account. When we first started trading many years ago, we did exactly what every other trader does. We searched all over Google, read every article, spent hours and hours watching every YouTube video, spent thousands on courses, tried every indicator available, but failed nonetheless. It wasn't until we were trained by true price action specialists that we were able to break through and discover that price action is all you need. We don't want you to have to go through the same struggles we had to go through and lose a lot of money, but even worse, losing time you'll never get back. This is why we created WiseTrade, to act as a shortcut for traders to not have to go through what we did. Now, we know how committed you are to your trading success as you have sat through this entire training. So we have a very special offer for you and something we have never done before, where you can get complete access to our trading masterclass for only $97. A one-time payment of